All right, so you've got your first $1,000 ready to invest. In this video, I'm gonna show you exactly how to break this up and divide it into different investments, as well as where to invest the money. And I'll also tell you how to review your investments once you put this money into investments. How many times am I gonna say investment? Anyways, we will also talk about how to review this, when to make changes, and this is basically gonna be your quick start guide to getting your first $1,000 invested. So let's get into it. Now, before you get going with this strategy, I would suggest having your high interest debt paid off and having an emergency fund in the bank, because otherwise it's too easy to just pull into these investments. And if the market is down, then you're really gonna lose money because you'll be pulling out less than you even put in. And that's not the point of investing. So just a little note there, if you've got that high interest debt, take care of that first and then come back to this video. Whether you're investing for retirement or investing for goals, maybe pre-retirement, you can use this same exact strategy for either approach. Just keep in mind, if it's for longer term investing, you can be more aggressive because you have both time and income on your side to recover from large market losses. You've got to get your accounts open so that you have a place to buy your investments. I really suggest Fidelity for beginners because they offer fractional share investing, meaning you don't have to have the whole dollar amount to get some individual stocks. And they've got a lot of other perks for beginners. Take a look at this video if you want some more information, more specifically on Vanguard, but you can really go with any firm that you like if you already have one in mind. I would say that I personally do not like Robinhood or any of those others that are specifically apps only or app based, because they really gamify investing and they try to incentivize you to buy trendy stocks. And that's not really going to get you long-term success. You can actually see that Robinhood's typical account performance is lower than the S&P 500. So that's a clear sign that they're doing something within that platform that really is not helping their users find success in investing. And also, they don't have a helpline. If you need to actually talk with somebody, you have to send emails or chats, and it's just a longer process versus picking up the phone like you can with pretty much any major brokerage firm any time of day or night and get an answer to the question that you're wondering. And now, whether you have your IRA or your brokerage account, let's get into how you can actually divide up your money and get invested. I like to follow the strategy of 80% in index funds and think of this as your core portfolio, and then 20% in individual stocks, maybe a portion of that into more risky investments if you do have your eye on some other things. But have this solid strategy in place first, and then you can add this on top to take a little risk, maybe add some growth potential to this, but you want to have something that's solid that you can kind of count on year after year after year. And if this does great, amazing. And if not, then at least you have this to fall back on. Let's start with this bucket. It's 80%. So of $1,000, it's $800. I would suggest splitting this up into 3 index funds. And first, we're going to cover if you're an aggressive investor, meaning you don't need this money for at least 10 years or more. You could take $400 and put it into a large cap index fund. I would use the S&P 500 just because it's a basket of 500 of America's largest companies. It's going to be companies that you know and use on a regular daily basis, and you're going to be much more familiar with what's going on in this basket because you're buying the products and services that's composed of these investments here. So that's going to be with $400. You can just type in S&P 500 index fund wherever you're investing, and they'll give you some options. So just choose one of those because it's going to keep the costs really low. Next, you're going to take this 400, split it in 2, and invest in a small or medium or combination like a small mid. But you could just go with a small cap to keep it simple. A small cap index fund. So that's what you'll enter into the search bar, and you buy $200 worth of that. I would find an international index fund that excludes the US because this money is going to be US based. So it's an additional way to diversify yourself in this 80% bucket. And again, you just search International Index Fund and see what they have to offer. So that's with $200. Now you've got your 80% bucket, and that really can create a decent investment strategy for you to get started with because it offers some diversification. You have some large companies, some small companies, and by small, it's not your mom and pop shops, but it's like much smaller than those that are in the S&P 500. So it offers some differences in your investments, and actually each year, they all take their turn on what's performing best. So that's why it's nice to kind of have a few of each of them so that you have that opportunity to be in the one that does best that year, but you also don't have all of your money in just one, just in case it doesn't do as well, then you're not overexposed in just one specific area. And the internationals, of course, are a much better way to offer that diversification of the other two because they do tend to perform differently than the US based stock. Usually you will see the small and large cap kind of mirroring each other as far as performance, even though some years one does better than the other, they still very much move in sync versus the internationals. Those do move a little bit differently, still somewhat in sync, but not a mirror image basically. So now let's get to the $200. This I like to just buy 2 stocks, okay? But you could also split this up and buy $50 worth of 4 different stocks. I wouldn't get too many because it really becomes difficult to manage. And then you're also just replicating basket of funds if you split this up into way too many different individual stocks. You have to think of the saying, concentration builds wealth while diversification maintains it. So if you get concentrated, and $200 is not gonna really magnify your wealth, we're just creating the starting point, right? This is the blueprint that you can then add to every time you get paid over the years. And it can really grow your portfolio exponentially, but you've got to get started. So I would just choose 2 stocks from companies that you use on a very regular basis. Look around your house, look at where you're spending money. Do you order from Amazon all the time? Are all of your products Apple? Do you drink Starbucks every day? What are you using? And just keep it simple because not only will you be more in tune with what's going on with those stocks, you'll like understand it a bit more if they're dropping and you can say like, oh, when was the last time I went to Starbucks? And you know, there's just like more of that connection. And when you actually shop at the place, you're benefiting from the growth that they're seeing. You're giving them money and they're giving you a teeny tiny fraction of that in growth, but that's how you kind of stay connected to that company that you're invested in. If you try to pick random stocks, you can do that as well. Maybe you break $100 up into smaller chunks and you've got something like this. You can split this up into maybe $70 into one thing and then $25 into something that's more risky if you want to take a chance on something, but maybe not too much. So that will help you understand, like when you do see the movements, you can then say, okay, I don't like that type of movement. Maybe it's like really dramatic, or you can say, you know what, I'm okay with it. That starting point of having some skin in the game and really seeing how you feel when your money moves up and down will help you formulate that base of understanding. So when you have more and more money that you're putting into this, and maybe you've got more than $1,000 sitting around in the bank, but you're kind of just getting started with this first 1,000, it will help you gain clarity as to what to expect, because you can take what you earn and you could multiply it by a higher dollar value and pretend you have more money invested and see how you would feel if the market dropped 40% and now your $1,000 is only worth $600, right? How would you feel? And imagine if that was 10,000 or 100,000. If you had 100,000 invested and it dropped 40% like it did in 2008, not that long ago, then you would only have $60,000. So if you cannot tolerate that type of risk, which is reality, investing in the stock market, then maybe you get something a little more conservative. So real quick, I'm going to go over a more conservative option with your $1,000 if you're a little bit nervous to kind of put it all in. So let's use the same $1,000, and going back to what I was saying earlier, with this 20%, if you don't like the idea of individual stocks, don't do it. Just take the $1,000 and divide it into 3 or 4 index funds. You don't have to invest in stocks at all. I like stocks because we're personally invested in stocks and we have benefited from that growth. But if you would prefer just to avoid that altogether, keep it even more simple, just go ahead and skip the stocks, and then you could just break it up into a little bit higher portions into index funds. Now let's get into a more conservative option. So you can take that 80%, we'll still kind of use the 80% example. You could take the 400 and invest it into large cap, just like the aggressive portfolio. But then with this other 400, maybe you split it into some bond funds, some bond index funds, or even bond mutual funds. Sometimes those do really well. So look at the performance, just enter them into Google and it'll give you a nice little chart of historical performance. And this will allow you to have a more conservative portfolio because you're balancing in some bonds as well as some stocks. You're gonna see very, very little growth here. But if there is a big downturn, you're going to see a lot less of a drop here than you are with the stock portfolio. Just kind of toy with this, and you're based on like how much risk you want to take. And then the 200, you could still do a couple of stocks if you want. You could do a couple of individual bonds. If you are more conservative, you probably want to stay away from individual bonds. So I would more lean towards keeping it all in index funds. Now, once you get this all invested and you've got your investments in place, you can just set up automatic deposits. If you know how much you'd like to get invested every single month, make that happen automatically. You just go into the investment firm's transfer section and look for the connection between your bank. If you haven't added it already, add it, and you'll be able to set up recurring deposits. If you need help with this, call their help desk. This is why it's so great to be with a big brokerage firm, because they have people that walk you through that. And then once you have the automatic deposit going in, set up automatic purchases of index funds if your firm allows it. Again, give them a call. They will walk you through it, and it makes it really easy because then it takes it all off of your mind. You just put it on autopilot and get back to living your life knowing that your money is growing for you in the background. And when it comes time to review, I do this once a year. I think that is plenty, especially when you took some time to purchase your investments. You know you want to stay out of it for the most part, except putting money in. Once a year, sit down, look at how things are doing, readjust, add more if you can afford it. If you did buy some stocks, see how those are doing. Check out price targets for future projections and see if you want to make any changes. But let that be a scheduled event that happens. Do not do this in response to what's happening in the news, what's happening in the markets. You have got to tune out, because that is the number one reason individual investors fail at managing their own money, because they cannot disassociate their emotions with the reality of their money being invested. It's really, really, really difficult to do. It's called emotional investing, and learn about the pitfalls. Just Google that. You'll see what's likely to happen if you don't get your emotions in check and if you allow yourself to make changes based on what's going on versus just your nice annual review that you do. It becomes a lot easier to stay invested over the long run. Now, if your head is spinning from all of this, I will be opening up my course for enrollment. I am so excited to take my 3rd cohort of students. It is just going to be really great because I want this to be your year, the year that you get invested and you're able to put money in on a schedule over time and feel really good about growing your wealth. It does not feel good when we're sitting on the sidelines, feeling unsure, feeling behind, feeling like we're not doing enough. Let me help you through this process and get you started. I think that's all I have for you. Let me know if you have any questions below, and I'll see you on the next one. Bye.